Hello guys, once again. Today is a lesson 4 of the training program, and this lesson is going to be focusing on leverage and margin. And at the end of this lesson, you will understand leverage, understand margin, know margin calculations, understand risk amplification, use leverage professionally. Now, in Forex, traders can control positions much larger than their account balance. This is possible because of leverage. Leverage increase profit potential but also increase risk. So understanding leverage and margin is essential for survival in trading. So in this training or in this lesson, we are going to be covering how leverage is used effectively, and then we'll learn how to use it practically as well. Now, what is leverage? Leverage is borrowed capital from your broker that allows you to open larger trades than your account balance. It is expressed as a ratio 1:10, 1:50, 1:100, 1:500. You can even have up to 1:20,000, or you can have up to 1:unlimited. It depends on the amount of leverage your broker can accommodate to give you. Now, these are some examples of account balance and leverage usage. Now, if you have $100 account and you are using 1:100 leverage, you can control a position size of up to a maximum of $10,000. Now, so leverage multiplies your buying power. So if you have $100 in your account, you can buy currency units up to a maximum of $10,000. Now, if this leverage was increased to 1,000, that means that will be 100,000 buying power. Now, let's move on. Now, 2. What is margin? Margin is the amount of your own money required to open and maintain a leveraged trade. Think of margin as a security deposit held by the broker. Now, when you deposit money into the broker, you are not using that money to open trades, but you are using that money as a leverage or as a collateral for your broker to hold it for you. Then you borrow, let's say in this case, you borrow $10,000 to trade on the financial market. Now, that is what happens in the financial market. If you have $100, you can't open a trade of $100. You have to get a leverage which will increase your capital, and then you'll be able to open a position size of up to $1,000, $10,000 and above. Now, this is the example of margin usage. Now we have a trade lot size of 0.1. If you don't understand lot size, you can check the other video to learn about lot sizes, because I will not be explaining it here. I've already explained it in a separate video which is on the YouTube channel. And then the position size you have is $10,000. That means that you are using 1:100, and then your account balance is $100. Now, if you are going to calculate the margin which is required, now $10,000 divided by $100 equals $100. Now, so to open a 0.1 lot size of trade, you need $100 margin. That is the amount you need to open Now let's look at this table. Leverage and lot size connections. Now if we have a lot size of one lot, which is a standard lot size, and then the position value is $100,000, and then the margin at 1:100 is $1,000, which means that before you can open a position size of one lot, you need an amount of $100,000 to be able to open one lot size. Now, the broker has the ability to borrow you capital. So instead of you depositing $100,000, you will deposit $1,000. Then you will use a leverage of 1:100, which will give you 1,000 times 100, which will give you the ability to open a position size of one lot. And then the same goes for the 0.5 lot. You need $50,000, and you need a collateral of $500. The same goes with this. The same goes with all the rest. Now, if you look closely, you get to realize that the 0.01 requires $1,000 to be open, and the deposit or the margin or free margin expected for it to be possible is $10. Now, in some cases, you can deposit $10 into your account. Then instead of you using 1:100, you can decide to use 1:1,000, 1:1,000, which will give you a buying power of 10,000. So in this case, this your $10 which will be required to open a trade will now be $1. Now let's move on. You understand that when we get deeper. Now we have the profit and leverage aspect. Without leverage, your account size is just $100, which is tiny trade, tiny profit. That means that with $100, you might not be able to open a trade. That is, if your broker doesn't allow lot size below 0.01. If it allows mini loss like 0.001 and then so forth and so on, if it allows that, then you can be able to open a trade with this your $100 without leverage. But if in a case your broker doesn't allow that, and there are no brokers which allows that, the most minimum lot in all brokers is 0.01 lot size. Now with leverage, you have $100 in your account, you are multiplying it by 100, you are getting 10,000. Then you can trade meaningfully to get meaningful profit as well. So if you have $100 in your account, you open a trade of 0.1 lots, and then the price moves 10 pips, you are making $10. Without leverage, you could not open that size. Without leverage, you can't open 0.1 lot size. But with leverage, it's possible. You can open 0.1 lot size because you need $10,000 to open a 0.1 lot of trade. Now let's move on to the risk amplification. This is the dangerous aspect of leverage. Now, leverage multiplies losses the same way. Example, if you are using a lot size of 0.1, then price moves 50 pips less or 50 pips against your trade, or 50 pips of currency depreciation. If you open a position predicting that the US dollar will rise in value within a specific amount of time, then it happens that the US dollar depreciates in value, and then the British pound appreciates, then you will be making a loss of $50. That is if it depreciates to 50 pips. If it depreciates to 50 pip lot size or 50 pip losses. Now on $100 account, that is 50% loss. Now in trading, percentages is very important. We'll treat it subsequently in this lesson. Now, high leverage makes account blow quickly if misused. If you have a high leverage on your account and you don't use it well, it can easily blow out your account. That means that your account can easily trigger margin call. Now let's move to the margin level and margin calls. Now with the margin level and margin calls, your account has these three things, or what will I say, maybe five things or four things. Okay, now these are what your account has. It has the balance, your deposit, it has the equity, the amount which is available at a given time, either on a loss or in a profit. This balance contains all the closed trades, and this equity contains all the unclosed trades, including losses and profit. The same goes with the balance. Now we have the used margin, and the margin, I already explained that. The margin is when you borrow capital from the broker to trade, you are able to use some certain amount of capital that you deposit in your balance to open a trade, and that margin will always be indicated. Now the free margin is the amount of margin still left. That means that the amount of trades you can still open. Now if losses reduce too much, margin level drops. Broker calls trades automatically, closes trades automatically. This is called margin call or stop out. Now professionals use leverage. Professionals do not use maximum leverage. They control risks. They control risk by small lot sizes, low percentage risk per trade, adequate free margin usage. And the key rule is leverage is a tool, it's not an obligation. The fact that the broker has borrowed you hundreds of thousands of dollars doesn't mean that you should use all. That will trigger margin calls and eventually stop you out. Now, safe leverage mindset. Beginner mistakes. High leverage is equal to more profit. Professional truth. Position size determines risk. Leverage only allows access. Now, this is a real trade comparison. Now, let's say you have an account balance of $500. Trade A, safe. You open a lot trade of 0.05 lot. your SL, that's your stop loss, is positioned at 30 pips, which we are risking $15. Now, trader B over leverage use 0.5 lot. The same 30 pip SL is losing $150. Same setup, but different leverage usage. Trader B blows faster. Trader B blows faster because just 4 or 3 losses in a row, the account is gone. But with Trader A, you can lose $15, and then you can target maybe 1:5. Then you get 15 times 5 anytime a trade goes in your favor. And that means that you now have 15 more buying power, or 5 more buying power to add to your $15. That's if you lose $15, you'll be making somewhere around 15 times 5. So let's say 5 times 1 is 5. 5 times 5, 25. So that means that you are making $75 profit if the trade goes in your favor. But if the trade does not go in your favor, you are losing $15. Now let's move on to the core principles. Now the core principles here are: leverage increases buying power. It increases buying power. Profit speed, loss speed, margin usage. So leverage simply amplifies outcomes. Now we have come to the end of this lesson 4, which talked about understanding leverage, understanding margin, knowing margin calculation, understanding risk amplification, leverage, use leverage professionally. So thank you very much for watching. Please do like and subscribe, and probably share it to the person who is also in need of this video. A lot of traders rush into trading just because of the profit without taking their time to learn all this. And this is an opportunity for you guys to learn everything. After this trading program, I will be giving out signals, and I will be training you on how to catch trades and make profit from every single trade you enter. At least 1:10 will be achievable, but my minimum is always 1:3, which is 3 times of what you would have lost if you open a trade. My name is Elijah Mensua. I thank you all for watching this video, and I thank you all for being a part of this training. See you next time.